Okay, so from the macro, we're going to go down somewhat to the micro and talk about the kind of more specific reform issues. Yiping will talk about the benefit. I'll keep that one. So, yeah, sure. Yiping will talk about internet finance, something which we know is very close to my heart, and pocketbook.
Thank you. Good morning, everybody. I'd like to just introduce to you very briefly. 5 minutes or 10 minutes?
5,
anyway.
And I'll cut you off at 7.
Okay, well, anyway, internet finance is something relatively new. It's happening, but just in case Steve cuts me off early, I'll leave you 3 key points I'd like to tell you. The first is internet finance has become one of the key forms of inclusive finance in China. It's really growing very dramatically, partly because there have been a large groups of individuals and enterprises that were financially underserviced. And at the same time, because the internet technology, meaning the mobile terminals and big data analysis, are really growing and developing. But the second point, I think we really need proper financial regulation now, even for this sector, particularly consumer protection, I think very important, partly because most participants in this sector are relatively less literate financially, and so we need some regulation. And at the same time, we are seeing some Ponzi schemes, things like that. But final point is, I do think China has the potential to become a global leader in this area, especially if what we're seeing at the moment makes continuous progress, i.e. the internet technology is effectively utilized to assist risk pricing, and I think that will have a concrete result. Internet finance often defined in different ways. You could look at either the traditional financial institutions using the IT technology, or the IT companies providing financial services. My talk today mainly focuses on the second part of the story. And if you look at the main business, I have a list here. I guess I don't have the time to go through the details, but the main business that we are seeing at the moment, third-party payment, online lending, crowdfunding, distribution of the investment products, insurance, online banks, and internet currency. A lot of things happening at the moment. In the end, I will use the peer-to-peer lending platforms as a case just to show you the new development. But the first thing I want to show you is, well, we have a new center or institute of internet finance at the Peking University. It was jointly established by the university, the Alibaba's Ant Financial, and the China Finance 40 Forum. The center, the institute, was established officially in October last year, and the first job we did was to compile this so-called Peking University Internet Finance Development Index. I don't have the time to look at to talk through the details, but I just show you some of the numbers here. The dark blue line shows the development of the sector, setting January of 2014 as 100. And then the numbers you look at, the last data point was for September 2015. And as you can see, the month-on-month growth rate was roughly at around 6%, which means it doubles every year, the internet finance. I mean, we classify into different sectors and different areas. If you look at the regional distribution, you can find that the dark color means more developed in terms of internet finance, and the coastal areas much more developed than some other regions. It's an interesting story. In terms of population by age, you find that the internet finance really is driven by activities by people who were born in the 1980s and the 1990s, and this is a more like younger population phenomenon. There is obviously a big question whether this can actually become a concrete, a real financial sector. There are still people debating in China and outside of China. Some people think this is a really big revolution, breakthrough. Others think this simply is a bubble based on the regulatory arbitrage. My own sense is there are some bubbles and there are some risks at the moment, but some real concrete progress is happening, really meaning many companies are actually able to utilize the mobile terminal connecting the users of something like 600 to 700 million population. At the same time, using big data to analyze risk and to make a financial decision. One good example is Alibaba's Ant Financial or Ant microcredit. They're able to extend a loan within 3 minutes. You apply, you submit your application, they approve it, and the money is in your account within 3 minutes. And their non-performing loan ratio at the moment is below 1%. They never see their clients. They just look at the data. So I'm not saying everybody can do this, but this is happening. So my own sense is this could actually become a very useful way of inclusive finance. And part of the reason is the reason why it's developing so quickly. Some people say because there's no regulation. Well, that's probably one reason. But I think it's more importantly because you have like hundreds of millions of people are never well serviced by the traditional financial industry. And you certainly have like 80% of the SMEs in China never borrow the money from the banks, and they need to access to finance. Internet finance is helping. So the critical test, obviously, is whether or not internet can help with risk pricing, and that's the critical test. So not everybody will succeed. Just quickly, as I said, I'll look at the P2P platform as an example. This is basically an online lending platform. You have something in your country, in the US, in UK, but really you see a very large population happening, the direct financing, borrowing through the internet. There are different types of P2P platforms. Some only do information intermediary. Some transfer liabilities from the investors, and some introduce third-party guarantors. And finally, there are some just platforms to be utilized by micro-financial companies. But anyway, there are lots of different types at the moment. The government has just proposed a new regulatory framework last week, a week or two. They want to introduce a new framework. If I have time, I'll discuss a little bit. But what I want to show you is, number one, this sector is really growing. You look at the number of the platforms and the total loans at the moment. Last year, I think the total loans extended through the P2P platforms would be more than 1 trillion yuan. And that is still relatively small number compared to new bank lending last year, probably was around 12 trillion yuan. So it's not insignificant. It's relatively small, but it's growing very quickly. You look at the percentage growth I put up in the end. The interest rate is gradually stabilizing after an initial period of very volatile change. And now it looks like it's settling between, on the bottom is the 1-year bank lending rate. And on the up front is the Wenzhou informal lending rate. And in between, this is the P2P average interest rate. My own sense is that's probably where it will be because it's more market-oriented than the commercial banks, but it's much more formal and structured than the Wenzhou informal market. And that serves a particular component of the market. The problem is platforms growing very quickly. You look at the last row, and we compiled some numbers from the system, and we compiled the data for 3,439 platforms. Unfortunately, 1,073 platforms are problematic, which means in every 3 platforms, one is problematic, and that is becoming a big problem today. So what we did last week, actually, with a couple of colleagues of mine, just to analyze what kind of factors contribute to problems in the platforms, and I will show you some analysis. Well, number one, if you look at the number of problem platforms across the country, you find that they actually concentrated in some areas. But if you look at the proportion of problem platforms in total, the concentration is not very clear. Then we look at some specific factors that contribute to the problem. That is called a KM survival curve. The lower curve means the lower probability to survive. The first thing we find was any platform with less registered capital is much more likely to default or to become problem. There are some other numbers as well, but I guess Steve is telling me to stop. So I will just summarize what we found. Of the more than 3,000 platforms we looked at, what we found was the platforms with more missing information, more recent establishment date, more abnormal interest rate, which means less than 8% or more than 20%, less products in terms of types and terms, and especially if the platforms offer VIP guaranteed payback service. These platforms are more likely to default, more likely to have problems, and more likely to have a shorter life expectancy. And that's what we found. So the implication to us was, on the one hand, we do find the P2P platforms are providing real financial services for individuals and for companies. But at the same time, because it's not regulated, some of the platforms just became problematic within 3 months after establishment. So I don't really think there's any good management reason why they would do that, and we're highly suspicious of the so-called Ponzi schemes. That leads to the question, well, what should we do now? My own sense is, I think this, as I said, I really think this is a good development, but it needs to be regulated properly. And with the new framework suggested by the government, basically they look at 3 things. Number one, my summary of the new regulatory framework. Number one is all P2P platforms should only engage in financial intermediation, information intermediation, no financial intermediation. The truth is 99% of them are all engaged in some kind of financial intermediation, not information intermediation. The second is the government doesn't want to set entry barriers or specific regulatory requirement. That probably means everybody can enter the market, which in my view is probably not a good idea, partly because most of the participants, as I said, are not very well literate or educated in terms of finance. And so some kind of screening and entry barrier, I think a qualification requirement will be necessary, and that's something need to be looked at. The third point in the framework is CBRC now want local governments to take charge of regulation of this sector. Again, I think that probably is not a very good idea, partly because P2P platforms, once they set up, businesses everywhere. It's not limited to one area. And also, at the same time, as we know, every local government has one finance office, but most of the offices do not have any regulatory capability. So I think we really need to think about this new proposal in order to facilitate a healthy development of the P2P industry. Thank you.
So Xiang Songzuo is going to talk about one of the greatly misunderstood issues, which is the RMB's entry into the SDR basket, which, if you read the reporting, has been remarkably inaccurate. But you will clarify all of this.
Thank you. Thank you, Stephen. Dr. Chin just discussed in very much detail the progress of internationalization of RMB. So First, I'd like to make brief comments on RMB exchange rates. You all know since the last August, the volatility of RMB exchange rate has been increasing hugely, and the gap between the exchange rates onshore and the offshore also expanded significantly. Particularly in these days, in the new year, you know, the exchange rate volatility has already impact hugely, I do think, the stock market. The stock market in these days, the trading days, almost a crisis or disaster. I think one reason is the people's worry about the depreciation, the further depreciation or even sharp depreciation of RMB. The reason I think there is three. First of all, the last August, the PBOC, the central bank, has changed the mechanism a little bit more to make exchange rate flexible and let the market forces to determine the so-called equilibrium exchange rates. The second, I think, of course, there is very much concern about Chinese economy and the slowing down of Chinese economy. And I remember last October, when just after release of the third quarter's figures of GDP, the former chairman, Federal Reserve Paul Volcker, visited Beijing. We met him, and he asked the economists, the 7 economists together to have a lunch with him. He asked, do you believe the third quarter figures of GDP growth? My answer is, if you don't believe the official figure, what kind of figure do you believe? Of course, this reflects the concern of overall about the slowing down of the Chinese economy, which of course reflects the concern, the expectation of depreciation of RMB. Thirdly, I think the most important issue is speculation. The speculation is huge between onshore and offshore. I don't know exact figures of speculative inflows, outflows. Of course, even within our reserve money, there is a quite large part of reserve money has been accumulated by so-called hard money. Even though a safe never released or discussed how large a part of hard money in the reserve. So I think that how to contain the speculative inflows, outflows in order to maintain the relatively stable exchange rate is a very, very tough job for Chinese authority, particularly for safe and the central bank. Yesterday, just after the sharp decline of offshore market RMB, the PBOC official website of PBOC published a piece of paper to re-emphasize the resolution and the confidence of central bank to maintain the stable exchange rate. Personally, I do think we have capacity, the PBOC has capacity to maintain the relatively stable exchange rate, which I think is a very, very important. I think it's a focus point of all policies in China this year, as well as for neighboring economies. So we must be very, very careful to manage, to maintain a stable exchange rate of RMB. First of all, I think we have a huge foreign exchange reserve. If PBOC wants to intervene the foreign exchange market, I think it can do with capacity, the so huge reserve money. The second, the slowing down of Chinese economy, I think there is over concern. Even though perhaps the guest audience, you don't believe the official figure of GDP growth. But frankly speaking, I do think this year the Chinese GDP will still remain growth between 6.5 to 6.8%. Compared with all major economies, I think that's a very high growth rate. Of course, India promised to grow more than 7% this year. And thirdly, I think even after inclusion of RMB into SDR, personally, I think the Chinese authority, the PBOC safe, still will be very, very cautious and adopt step measures to liberalize the so-called capital account. So I think exchange rate is very much relevant to the inclusion of RMB into SDR. For SDR deal of RMB, I think there are two important implications. First of all, according to the news release and the statements by IMF and Managing Director Lagarde, inclusion of RMB into SDR basket, first of all, confirms we have made great progress in our financial reform, opening up of financial market, financial industry, as well as internationalization of RMB. Yes, yesterday Yiping mentioned 3 decades ago, there is no financial market in China. There is only one bank, the PBOC. It's a central bank as well as commercial bank, only one bank. No share market, no equity, no bonds, no non-financial institutions. But now, after more than 3 decades, we have everything. Even though many aspects are not very mature or even perfect, but we have everything. We have equity markets, bond markets. So I think the inclusion of RMB into SDR is confirmation of our progress, our achievements. Certainly, of course, SDR deal will be a spur or encouragement for Chinese authority to do more in reforming financial markets, financial industries, and opening up more our financial market. I remember when we signed the deal of joining WTO, I think it's 2001, and there is a so-called promise after 1 decade by 2011. The assets held by foreign financial institutions would be 20% of total financial assets in China. But so far, according to latest figures, the assets held by foreign financial institutions is just a little bit less than 2%. So there is huge space for China to open up the financial market, financial industries. So Dr. Qin just discussed in very much detail the progress of internationalization of RMB and SDR. Joining SDR, of course, is a very important landmark. Looking forward, after joining SDR, I think the Chinese financial reform and opening up will go forward into 3 directions. First of all, we will promote to encourage the growing or innovation of financial markets. I think in the near future, the derivative markets, the commodity markets, and all other markets will be developed or expanded further. And now in terms of market capitalization and the trading volumes, the bond markets, China, and the equity markets is almost a third or fourth across the world, second equity markets. So I think looking forward, the financial market will become much richer and diversified. And Yiping just mentioned the internet finance. Internet finance is an emerging new sector of financial industries and is very promising. And Yiping said that China would be the leader in internet finance across the world. The third, I think, is we will increase the percentage of direct financing among the total social financing. Now, in terms of stock quantity, the indirect financing, major commercial banking lending, still account for 70% of total social financing. But that incremental amounts also the direct financing already account for almost 50%. So looking forward, I think direct financing, including equity, private equity, venture capital, bonds, and IPO, unfortunately, because of last year volatility, even a crisis, the stock market, the IPO stopped, suspended temporarily. But I wish this year the stock market will be operated better to launch IPO again. So IPO is a very, very important. If you look at the official document by the Communist Party Central Committee, emphasize the importance of IPO to finance the corporations' investment. So I think direct financing will play much bigger role in the social financing in the future. Thirdly, we will encourage the domestic financial institutions, including bankers and security firms and trust corporations and all other financial institutions to expand internationally. So I think that's the three directions after RMB joining SDR, the major directions of our strategy. Thank you.
All right, Haizhou is going to talk about kind of the perfect final presentation, further opening and reform of China's capital markets. And of course, he's going to give us his annual prediction of where the index is going to be in 12 months, and we will hold him to it. So Haizhou, I turn it over to you.
Okay.
And I think given the performance, you get 60 seconds to make your presentation.
All right, that's no problem, yeah. It's always a pleasure to be in here to present our view. I think that the theme of this today's conference is forecast of China's economy 2016. So I do want to provide the forecast first. This is the CIC's forecast. That's our forecast for China's GDP growth. I think our forecast is about 6.8%. That's China's GDP growth rate. CPI 1.3, and you can see other things. But I think that basically that for the 7 minutes or so, I want to quickly run into where China's economy is heading and where is this so-called a new normal in the financial markets and also in the economy. Financing costs in China is still quite high, and this is one of the charts show that actually at some point in 2010, and actually if you think about it's a long list of financial companies, and if you think of the RE and you think of other things, basically that the cost has been very high and is coming down, and that also provides some room for internet finance and other intermediation to play some role. In our view, that the financial conditions are still restrictive for growth recovery, which reflect that the real lending cost still remains quite high. Things are improving, I will tell you that, yeah. So as a result of the high financing costs and also some other problems in the economy, investment has been contracting. As you can tell, probably back before 2004, 2003, China's fixed asset investment growth year on year was over 50%. And as a result of the government stimulus package in 2008 to 2009, and actually FDI growth rate rebound back to 30%, and now of course it's inched around 10%, so this is much lower. If in terms of the real cost of the of financing, I think that the cost varies a lot. Okay, we divide the real cost into three areas. We think about the real interest rate for consumer using consumers' borrowing rate and minus CPI, and then we also calculated the real interest rate for producer, which is manufacturer's borrowing costs minus PPI. PPI is hugely negative, as you know. So basically, that if you think about the real financing costs, it varies from sector to sector. For consumers, are really it's reasonable. For manufacturers, I think that they're taking very a hard hit. Okay. And for property buyers, it varies. It depends on whether the price go up or go down. This is a chart Dr. Chin also showed you, which is basically that over the last few years, in particular after the 2005 exchange reform, renminbi indeed has been, if you measure it in terms of real effective exchange rate, has been appreciated significantly. Okay. So China's export growth also over the time came down quite a lot. Recently, in terms of financing costs, indeed there is some improvement. Okay, one of the improvement is the government bond yield start to drop. Okay, and the government bond yield also remain quite high, and also that the corporate leverage ratio actually since 2008 went up a lot. Okay, after the 2008 crisis, if you divide the world into 3 blocks. I like to divide the world into 3 blocks: U.S., Euro area, and the emerging markets. What happened is that the U.S. economy successfully went through the deleveraging process by and large by now. Okay, in Europe there is not much progress in deleveraging. They made little progress, but not much. In emerging market, China is part of that. As a whole, most of the emerging market leverage up massively. China is a part of that story. Okay. So I think that the government start to focus on deleveraging. I think that's something China will need to do. Okay, but how to do it, I think that's the key. Corporate bond yield start to fall, which is reflecting financing costs start to come down somewhat. Okay, I think that, and also if you think about liquidity in China, in particular in the financial market, also it start to improve. Okay. A few years back, if you, 2013, and if you think about the financing product, anyone issue financing product can actually get a very high return without facing much risk. Turn to equity market. Equity market basically that last year, I think that China start to support margin lending, and all of a sudden that the margin financing went up so much. Okay. In June, we had a meeting in Beijing between the U.S. delegation, Chinese delegation. I showed the chart, and actually I was nervous at that time that the ratio was not reached to 8.7% yet, but it was getting there. But I think that if you look at that kind of high ratio relative to the U.S. level, 2%, I think that you probably see that some kind of serious risk was in the market, and indeed the market has started to make a serious correction. Okay. After the serious correction in the summer, I think that liquidity start to return to the market and somewhat, and also that the market rebound somewhat, but also in the last few days, the market volatility increased globally in China, also in the United States. So if you think about the valuation, the Asia market, I think that many sectors are still above historical average. We had a discussion yesterday with our U.S. colleagues about this. Okay, I didn't show you the chart, but this is the chart. However, if you think about the Hong Kong market, okay, the H-share market, which is China's equity listed in Hong Kong, and they are very much below historical average, even closer to the 2008 to 2009 level. Okay, so actually, if you think about China's equity market, you think about the index of valuation, there are 3 different perspectives I would think. There is a Hong Kong perspective, which is basically mostly large SOEs listed in Hong Kong, valued by international investors. This is the Hong Kong perspective. This, of course, is domestically Shanghai perspective. Again, large SOEs listed in Shanghai, and then valued by Chinese domestic institutional investors, or maybe some retail investors. This is Shenzhen index. New technology companies, private companies listed in Shenzhen, valued by mostly Chinese retail investors. You know the valuation difference. Shenzhen is the highest, followed by Shanghai, then followed the Hong Kong is the lowest. Okay, I think that's something I just want to draw to your attention. Okay. In the next 2 minutes, remaining 2 minutes, I want to talk about some longer-term issues because I do want to focus on the opening up of reform in China's capital market. Dr. Qin also talked about that, and so that can save us some time. But I just want to show you maybe 2 charts or a few charts. First of all, the China story is very much about the reform and opening up. Okay, a major turning point. This is China's foreign trade. If you think about China's foreign trade as year 2001 was a major turning point. 2001, China joined WTO. Okay, that shows clearly that China contributed enormously to the world. China benefited enormously to the world integration. This is the second chart I like to show you, which is I think China benefited enormously from the reform and opening up. Okay, the left panel shows China's trade as a world total amount trade. The right-hand side is China's reserve. Remember, by 2000, China's total amount of reserve was only about 166 billion. Okay, I think that the amount of increase is quite a phenomenon. With the rapid growth and there is, Justin Lin and others talk about, China's growth perspective going forward. I want to show one chart to you, which is basically show you where China is. Okay, despite the rapid progress in GDP growth, in GDP per capita and the income level, if you measure GDP per capita, China's against the U.S. GDP per capita, China now stands at about 13% of U.S. level. Okay, and if you compare that with many other countries, Korea, Malaysia, Brazil, some other countries, I think that China still has a long way to go to catch up. I think that's the point I want to keep in mind. So I like to think about China in longer term in 4 dimensions. One, I like to think it as a large economy, so there is space to grow, and also the graduate model can apply. The east coast of China, in China, some people think is China's Europe-China standard. The west part of China is China's Africa. Of course, it's China's Africa in a way. So there is huge gap. So there is the graduate model would apply. Secondly, China is a developing country. Okay, as I said, that there is a long way to catch up through urbanization and industrialization. Thirdly, China is a transition economy with effective implementation policy and a strong leadership. Fourthly, I put a question mark. Okay, nowadays I think that there is a lot of worry about the risk in the China financial system. I would like to say that maybe China is overinsured. Okay, well, you overinsured, you could still have a problem. Okay, but basically you have the means. Okay, there are many dimensions that we can talk about overinsurance. One, of course, is the savings rate. Okay, household saving, basically that if you think about the household saving, the total amount deposited is about 79% GDP. The total amount debt of a household is 37% GDP. Okay, I think this is very, very important to keep in mind. Even if you look at the government, if you take all the deposit of the government, Dr. Liang Hong, our chief economist, put this figure. It's basically that the government did not really borrow much. Okay, 20% of GDP, everything, local, central, everything add together. Okay, so I think that there is huge amount of saving in the economy, the reserve requirement, and the foreign reserve, so on and so forth. Yeah. In terms of the longer term perspective, I think that a new economy is emerging. This is, as I said, that investors already voted for the new economy. Okay, so if you think about it, the valuation for new economy is much better than the old economy. Deleveraging. If you think about the deleveraging, and China does need to do deleveraging, but then again, there is two tails, a tail of two enterprises. Private sector's leverage ratio is not that high. Okay, it's really the SOEs. Okay, that's quite clearly. So I think that come to the reform, I think that financial reform is on top of the agenda. And this is basically, you look at it from the third plan and I list 7 major items. Probably the way to read it is from bottom to top, okay, gradually moving. Already China easily family planning. And I think that SDR reflect a major milestone for a new round of opening up. We hope that there will be land reform and also getting into SOE reform. I probably use my time to answer questions, but I want to keep, I want to leave you with the last figure, which is that according to the IMF, I worked at the IMF. This is the IMF forecast for the next 10 years growth. Where does the growth come from for the next 10 years for the what? Which country contribute to what percent? There are only 2 nations for the next 10 years that would contribute to double-digit growth to what 100% GDP growth rate. US 11%, China 25%. The whole Western Europe combined 7.2%. Whole Latin American combined 6.9%. Whole African combined 5.7%. So never ignore China, because you cannot really win by ignore a country that would contribute 25% of world total GDP growth rate. Thank you so much.
Well, Haizhou, the first question is actually for you. I always look forward to your prediction about where the where the index will be
I
at
haven't
the end of
put-
next year, but I didn't hear it this year. What's going on?
No. I suggest you read CIC's report. We have
Well,
our
I don't-
strategy-
I
our
want the
strategy for
audience
Yeah,
to
yeah.
G-
Well,
I want the audience to hear not to have to read the report. They want to know now, so they can go out and buy Jan van Eck's index fund.
Next question. Yeah.
So we're not getting an answer this year. Wow. Then let me rephrase the question.
Yeah.
The China economic policy is often described as kind of feeling the stones as you cross the river. So the concept is you step on a stone. If it's kind of a slippery stone, you step back and you try another stone. What do you think the implications are of this? You know, the news that Michelle broke about an hour and a half ago, that the circuit breakers policy has been suspended, or the rules have been suspended. And what does this do for investors' confidence in the market?
For me?
Yes.
Oh, okay. Perhaps it's a slippery stone. I think that then they changed their mind. I think it's changed mind quickly. Yeah, that's within a week. On January 4th was first day that China adopted this short circuit mechanism, and on the first day, the short circuit was triggered, and so and then next day almost triggered, and I think that. Over a week, if it triggers several times, I think that it shows that, I think that they, I think that they probably the parameter is not set not precisely right, in my view. You don't want to, let's say that in your home, you don't want to every day that you face a short circuit. That's not a really good thing.
What do you tell your clients who are long the A-share market? Buy, sell, or hold?
Valuation, I think that the valuation is indeed reasonable and even attractive. The Hong Kong valuation is very attractive. That's I think that I didn't put forward a suggestion exactly, but I think that the implicit suggestion is quite clear in the following sense. If you would read the Hong Kong valuation, you take it at face value, then the conclusion, a simple conclusion, again at the face value, would suggest that there would be something equivalent to the 2008 to 2009 crisis.
So are you suggesting
If
arbitrage between the H-share market and the A-share market?
No, I think that the Hong Kong market behavior different from the Asia market for several reasons. Reason number one is international liquidity. Okay, emerging market as a whole has been taken a bit since last year, as we know. A number of emerging markets got into recession: Brazil, Russia, and numerous emerging markets, even in this part of the world, let's say Mexico or Chile. Last year, they escaped recession if you measure by GDP growth rate. However, that if you the currency devalued against the US dollar by 20-30%. Last year, 2015, there are numerous countries, emerging market economy, with the currency devalued against the dollar by 15 to 55%. Let's put it that way. There are so many countries. If you think about it from international investors' perspective, I met with international investors quite often. If they do not do hedge, okay, if they invest in US dollar, actually their return last year was miserable. Okay, so I think that there's one reason, of course, in Hong Kong dollar is pegged to the US dollar. So in a way that there is no movement of exchange rate. So anything happened would reflect in through the for equity investors through the index. So I think that's the first reason. International liquidity since last year has been leaving emerging market to advanced economies, to largely to Europe, and also to Japan, also to some extent to the United States. So I think this is the first thing we need to notice. Secondly, of course, as I say that Hong Kong H share reflect, largely state-owned enterprises, and even for Chinese investors, I think that Chinese investors like a new economy better. I show you a chart. Okay, not really the old economy.
Only because I'm such a great friend of Haizhou do I dare put him on the hot seat like
That's
that
okay.
continually and don't let him get off of. But let me turn to Songzuo. The SDR, China's approval to become part of the SDR basket has been interpreted in some areas in the world and by media as a precursor to China becoming a reserve currencies for many central banks around the world. Can you talk about, it strikes me as kind of not the case, that we're probably more than a decade away, but can you talk about what it's going to take for the RMB to become really a reserve currency, and when will it really become a material part of central bank holdings? And give us a time frame.
Well, Dr. Xin just mentioned reserve currency is the third stage of internationalization of RMB. Well, now PBOC has signed 32 currency swap agreement with the foreign central bankers. Total is 3.2 trillion RMB. Basically, that's not exactly the foreign reserve money held by foreign central bankers, but it's equivalent to some kind of reserve. So I think that's a part of story. And also, several central bankers held RMB assets and RMB currency as a reserve currency, like Central Bank of Malaysia and several other countries. So I think it will take quite longer for RMB to become the real reserve currency. For real reserve currency, I mean the country will, calculate or even peg their currencies to RMB, and they use RMB to intervene the foreign exchange market to stabilize or manage the currencies. And so far, RMB has not been very important in this role. So I think essence is the confidence of foreign investors, foreign bankers with RMB. Of course, that depends on the Chinese economy and the financial markets. The foreign reserve currency, essentially, I think, is a vehicle of wealthy management or deposits by international investors. So international investors are willing to hold RMB as their currency of wealthy management or deposits, which means that many central bankers will be willing to hold this currency as a reserve in order to manage or stabilize the exchange rate. So I think it's a quite longer time to do that.
Long time is how long? Decade?
10 years?
20 years?
10 years, I think.
10. You mentioned, but the question is actually for Yiping, that in 2001, when China acceded to the WTO, we were thinking about, I think you said 20% international ownership.
I think it's an implicit promise.
I'm sorry?
Implicit.
Yeah, implicit. No, and I think in the insurance industry, when we talked about it, we thought that foreign insurance companies would have 10% of the insurance market. It wasn't written into the agreement, but it was implicit. It was discussed. If you look at the negotiating record, it's 2% ownership rather than 20%. It's less than 1% of the insurance market rather than the 10%. What happened? Yiping, what happened? Well, what's going on here, and what should we do going forward?
not sure if I'm the right person to answer this question. I do share your sentiment that the market should be much more open, and I feel that this is also the same goal for some of the policymakers now. I mean, I personally don't look at the insurance market, but I look at the commercial banks. Certainly,
Same would be true.
That's certainly the case. The share initially increased a bit, but then fell back, and then probably still between 2 to 3%, and that's certainly way less than what we expected. Generally speaking, I think there are two reasons behind it. Number one, while the entry, the door has been opened wider for the foreign banks. Specific businesses you want to do in China still need approval by the regulators. So for instance, if you have a product you want to start, if you want to open a new branch, they lifted the restrictions, the administrative restrictions, but they require massive capital to put down to open a branch. And my understanding in my interaction with many of the foreign banks is it probably is not worthwhile to put down that much money in the end if you can't open up a lot of business lines. So I think there's a regulatory question. But at the same time, there's also a question about the competition. I think the domestic banks, in terms of competitiveness, providing different services and so on, are actually also growing very rapidly. And some foreign banks actually find it threatening from the domestic banks, because in the older days, the gap between local and foreign banks were very wide, but the gap actually is narrowing. So, so some foreign banks actually find it increasingly difficult to expand businesses. Many of the foreign banks entered in anticipation of WTO entry, actually wrapped up and packed and went back home. So some of the banks came to China hoping that they would start develop their business, but in the end, what happened was they were only able to serve the companies coming from the same country, and that certainly is not enough. And I knew lots of examples. So I think there is a local knowledge question and there is a regulatory question. I think my own standing is we do need to make the playing field much more level for foreign banks to participate.
Stephen, I have a guess. I'm not sure. I think there is one reason. Another one is the so-called mutual favorable treatment. Mutual favorable treatment of Chinese financial institutions in foreign countries. For example, the Chinese commercial bankers, the branches of Chinese commercial bankers in these years find much more difficult to apply for new business in US, in UK, in Europe, personally. So Chinese authority, I don't think it's a retaliate. But I think because Chinese financial institutions are very difficult to expand business in overseas, in US, UK, Europe. So Chinese authorities, regulators, has become very reluctant to let foreign financial institutions to have more business. So I think that's one reason. I just guess.
Yeah, it's possible. Obviously, we would advocate both sides being more open to foreign banks, but I think that's a fair point. Let me open the floor to questions. We've got one back here.
I have a question to three panelists. We have seen like U.S. equity markets suffer.
You want to identify yourself?
Sure. My name is Sandra. I'm from Tencent Finance. I'm with Press, but Tencent is the largest internet company in China. So my question is, U.S. equity market actually suffered the three worst trading days following the sharp decline of A shares and sharp decline of RMB. That kind of reminds me what had happened in August last year. So is that kind of like U.S. investors overshoot, or they kind of misunderstand what had happened for the central bank policy. What's your thought on this? Anything you want to tell the U.S. investors? Thanks.
U.S. market or Chinese market?
Can't hear you.
Yeah, he's asking, you're talking about the U.S., so what advice would they give to U.S. investors?
Is there any way that the U.S. investors misunderstand what had happened in China, all those like special reforms or what had happened in Chinese market? Thanks.
No volunteers for that. No, my own view of that is that the Chinese stock market has historically been disassociated with the Chinese economy. That for years the Chinese economy grew at double digits and the stock market was flat. Then the Chinese economy has slower growth and the stock market soars, and now it's collapsing. It's somewhat, I think to say that's a reflection of the Chinese economy is probably not. So when you drive down the prices of U.S. companies that have China exposure as a result of the drop in the market in China, I kind of think not really. Anybody else want to add?
I don't think the correction a little bit U.S. market is due to the Chinese market. I think the global economy this year, according to almost every forecast, is not very good. It's quite pessimistic. So I do think this year will be very difficult to make money overall from the market. I think the correction is unavoidable.
Michelle.
Hi, Michelle Caruso Cabrera from CNBC. So the stock market is disconnected from the economy, but why do you think it sold off so sharply this week? And why do you think the currency moved so much this week?
You try currency, I try stocks.
I think it's overshooting. It's overshooting. I believe for RMB exchange rates, it's overreaction. Of course, the overshooting phenomenon is always here in financial market, particularly for exchange markets. It reacts so fast, overshooting. I think a long time we'll be stabilizing exchange rates. And PBOC is very clear, is resolved to maintain the stable exchange rates. Overall, of course, any exchange rate regime has a benefit cost. On balance, maintain relatively stable exchange rates, RMB, is not only helpful for Chinese economy, but also for neighboring economies. So, of course, there is a huge speculative trading. And so PBOC, I do think will take some measures to contain it.
I think one of the changes you probably noticed was the so-called effective exchange rate, the basket of currencies that PBOC adopted as the main reference for its exchange rate policy. That was a relatively new action. I think most people understand that the pressure for depreciation or devaluation has been here for at least a half a year now. And I think my own views, it's more related to, number one, the weakening of economic growth, and that looks like continuing. But at the same time, looks like there are also quite a lot of demand for capital outflow, whether it's a result of declining investment returns or it's because of opening of the capital account. So I think it looks like that pressure can continue for a while. My own sense is, as PBOC officials stated a couple of times, there isn't really a strong reason why the currency should weaken on sustainable basis. If you look at the economy, the current account is still in surplus. We don't borrow a lot of foreign debt, with the exception of some small areas. The aggregate borrowing overseas is still very insignificant. the foreign exchange reserve, while it's declining at the moment, is still massive in defending defending the exchange rate. So I don't think there are fundamental reasons why currency should weaken. But in the near term, as I said, the economy is weakening and the capital account is opening up. But bottom line is, if you look at while the currency is weakening against the dollar last couple of weeks or so, the effective exchange rate is relatively stable. So I would read it much more as a switch in terms of the policy target instead of just letting go and we're losing control.
On equity, I think that in general in the US, there is something called a January phenomenon, which is right after the new year, people are in a rush to make an investment, then the equity market start to move up. In China, because China, a lot of people still use the lunar calendar, there is something called a February effect after the Chinese New Year. Let's hope for the Chinese New Year.
Meredith, and that will be our last question.
Meredith Jano, Columbia University. If I may ask Yiping to say a little bit more about this internet financing. In particular, I'm wondering, as you look at this phenomena, are you also looking at data governance and how China's management of data might influence the growth of internet financing? And is there any role for foreign companies or technology companies or credit card companies in this phenomena?
Well, this is a relatively new area. The reason why we are seeing real progresses, but mostly with the companies already owning some types of data. So Alibaba has an online shopping platform, has something like 200 to 300 million customers, and more than 1 million SMEs selling products on the platform. So they're able to analyze the data and make a quicker decision. Tencent, they're doing the same thing with the WeBank, and they use the WeChat data. They have very skillful ideas how to analyze the credit rating for a person, depending on who he's interacting with and what kind of postings he's sending and so on. So lots of innovative progress is happening. But these are the companies, they already have access to data. Now, to be very honest, we don't have a very explicit policy to say whether this is allowed or this is not allowed. Bottom line is they're not sharing with other people. And so I think while we're all very optimistic about the future of big data analysis, there is no big data at the moment yet. In this sense, that's why I think a lot of smaller companies trying to enter, especially if they really want to use the big data technique, it's pretty difficult. My sense is if a foreign company want to enter, if you have a good technology, I think you can partner with the local companies like mini platforms and so on. Both Alibaba and Tencent are collaborating with, for instance, Dianping, Didi, Dace, and so on. They're all existing platforms, lots of data you can analyze. I suppose it will be very difficult for a foreign company to get into the country and start to collect data because that takes time. So I think the best way is just to set up a joint venture with local companies. We do have lots of local companies. They don't necessarily have the capability in analyzing the data.